Hi everyone, come on in, make yourself comfortable. We'll give everybody just a minute to get set and then we'll kick it off. Hi everyone, come on in. Make yourself comfortable. We're going to get started in just a minute. All right, well, welcome to our last webinar for 2021. My name is Jeff Thurrock. I'm the Director of Evalesco and Australian Advice Network, and I'll be your host for today. Australia's love affair with property certainly continues unabated. Today we're going to have a look at property from a slightly different angle than the normal residential conversation and focus more on commercial property. I'm very excited to be joined and live and in person here today for our first time in a little while that we've been in person with Cameron Williams, who's National Director from Colliers, and Marshall Brendel, who's a Director and award-winning investment guru from Evalesco and AAN. So thank you both for your time today.
Thank you, Jeff.
Thanks, Jeff. So I'll give a bit more of an introduction to Cameron shortly, but Cameron's going to provide us with initially an update on Australia's commercial property markets, and then we're going to have a bit of a Q&A with Cameron and Marshall about the opportunities for commercial property as an investment, where it might fit in the portfolio and how we can access it. So before we do that, just like to let you know that you're on mute at the moment, so we can't hear you for the extension of the webinar. But if you do have questions, and we would love to get questions from you, please type them in. So click on the Q&A button, type in those questions, and we'll endeavour to answer those on the way through or get to them at the end of the session. Also, just wanted to let you know that most of the conversation we have today will be about general financial markets and more factual information. So nothing we talk about today should be taken as financial advice, because right now we're not considering your personal financial circumstances. But if you would like to talk further, get in touch with Marshall or myself or your advisor. So this is Cameron, sitting next to me here, and his face up on the screen there. So Cameron's got over 25 years experience with office leasing and a major focus in the last 15 years on the Sydney CBD. You can see a list there of many of the high-profile office spaces and buildings in the CBD that Cameron has experience in working with, and he's now on the National Executive Leadership and Senior Leadership team at Colliers. So very well placed to talk to us about really quite topical subject with what's happening in the office space in the CBD. It's topical for us because we've just moved into our new office, so we've had a little bit of first-hand experience. But I'm going to hand it over to Cameron to run you through a bit of an update, and then we'll come back with some Q&A.
True. Thanks, Jeff. Good afternoon, everyone. Thanks for joining us. I thought what I would do is we'd start, with, as Jeff said, just with an update on the national office market, sort of set the scene a little bit. I think the first thing to note is, when we went into this global pandemic, vacancy across the Australian market was relatively in check, particularly in the Sydney CBD. So the Sydney CBD, the Melbourne CBD, they're in pretty good shape going into this global pandemic. Naturally, of course, we did see a change to vacancy rates as the pandemic progressed. We saw some sublease space come onto the market. Unsurprisingly, tenants were a little bit unsure about, how they were going to utilise their space going forward, and how the whole work from home piece was going to play out. So we did see quite a lot of space come onto the market. But I think what's really encouraging for the market, and we've seen this in previous cycles, we saw this during the financial crisis. The sublease space comes on and comes off really quickly. So, you'll get a situation where a whole lot of major corporates will put a lot of space on the market, and in an attempt to reduce overheads, reduce costs immediately. They quickly find that subleasing is a difficult venture, and it takes a lot of time, can often involve a lot of capital. And quite often too, circumstances change and they can change quickly. And I think I think that's playing out at the moment, particularly in Sydney, where we're seeing quite a lot of that sublease space that was put on the market is being withdrawn, so taken back by the tenant, because they're seeing populations return back into the office. Okay. It does differ across the cities. Melbourne's probably still experiencing a higher amount of sublease space at the moment, and that's probably unsurprising when you think about what Melbourne's gone through relative to Sydney. I won't spend too much more time on that piece. I just want to go into our inquiry data. So at Colliers, we specialise in office leasing. And, we've got probably something like a 25 to 30% market share across the country. We're operating all the major capitals. So I feel like we've got a pretty good handle on what's going on in the marketplace, good feel for the trends based on our market share. And we're operating in all parts of the market, be it metro or the major CBDs. What we're seeing is that our inquiry levels are up. And they're up pretty much across the board, but particularly in markets like Sydney. And it's not just inquiries; it is translating into deal activity. So if you have a look at this, I think this is an interesting slide. So that's the total area that's been leased year to date. So it was to the end of October 2021 versus the total area leased to the end of October 2020. And the number of transactions there, second column, total number 21, total number 2020 up to the end of October. So, significant amount of leasing going on, 434,000 square metres year to date across the country. Right? That's just the Colliers transaction activity, remember. So this is not representing the total market, but we've got a decent market share. And I think, if you look at the Sydney CBD, 158 transactions versus 105 in 2020. And what I can tell you is the final quarter, anecdotally, it will be the biggest quarter we've experienced on record. Wow. In Sydney CBD. So that's what it's shaping up to do. We've currently got 92 new leases in the Sydney CBD at solicitors. Okay, so we'll close those out by the end of the year, which will put us our total number over 250 there. So anyone who tells that the office is dead is misguided, because it's not what we're seeing on the ground. What we are seeing is tenants are absolutely looking for better quality premises, and they're looking for better quality locations. So if they're in a location which perhaps might be a little bit difficult to attract their staff back to the office, they're looking to improve that location to make sure that they can get people in. Yeah. Now, we're not saying that there won't be an impact from work from home. We think there will be. And what the challenge we think is going to be will be for these organisations to manage the peaks and troughs. So the expectation that we have is that it's going to vary significantly depending on people's personal situation. So we all know there's different times in our lives when it's actually a lot easier for us and it can be more productive to work from home. Probably not full time, but perhaps we're doing that 1, 2, 3 days a week. So we expect that trend will probably accelerate, and the technology supporting people working from home has obviously changed a lot, and organisations are stepping up and providing them, with that platform to allow them to do it. Yeah. So what we think this means is that, if you're a major corporate, a major consumer of office space, your challenge is, we're calling it the Tuesday space. What do you do on Tuesdays and Wednesdays when you've got the majority of your people in the office? Yep. And often there's organisations working agile environments, so they don't actually provide currently a desk for each headcount. They might provide a desk for 80% of their headcount. But on a Tuesday, you might be encouraging your people to come in and collaborate as teams, and you might find a situation where you've got 110% of the population in. Yep. So what does that mean? So What we think that means is, again, it's probably a flight to quality. We'll probably see a lot more churn over the next few years. We'll probably see organisations wanting to make changes to their current office to allow them to deal with this. We'll probably see institutional owners in particular step up and provide better quality-based building services that have, you know, what they call third spaces, which is basically flexible spaces for organisations. Yeah. So there's all that going on.
Is there any data? Or, you know, you talk about the Tuesday space. Is there data now tracking that's when more people are coming in the middle of the week, or is that starting to play?
There is, and most of the cities around the country are tracking it. And we look at data like public transport usage. There's counters on a lot of the buildings. If they've got a thoroughfare, like, you know, take something like 60 Margaret Street, the thoroughfare from Wynyard, they'll have a counter there. So you can see where the spikes are. And it's that Tuesday, Wednesday. Fridays for the younger staff.
Yeah.
Right? Because they want to be in this, it's a social day. Yeah. So you've got the younger staff coming in on Fridays, Thursdays and Fridays. Mondays seems to be quiet. I'm here on Monday, so
that's not my usual.
We're here, Jeff. And it changes by demographic, right? So one thing I thought was really fascinating was one of the major accountancy firms recently opened up their office, and the story I was told is that they had hundreds of young people waiting to get into the office that day. Yeah, but they turned all their access cards off, so they all had to go and get their access card reinstated. And apparently it was a lineup of young people, and it wasn't the older partners; it was the younger people that wanted to get in and collaborate, which is social. You know,
they're humans.
Yeah, that's right. So I think that, you know, there's a lot of things at play here. It's not just about cost saving. The reality is, you know, premises aren't actually a huge part of an organisation's cost. People is. Yeah. So it's really about people, and for a lot of organisations, you know, that's the key driver in a premises decision. Cutting back space by 5 or 10% is really just playing at the margins, and organisations that are typically doing big cutbacks in space, it's because there's underlying issues with that business. You know, it's not about trying to, you know, get more economic to make it stack up. Yeah. We've seen some massive deals in the Sydney CBD in particular in 2021, you know, and some big rents being achieved. The first one there, Moelis, you know, investment banking business that's moved from Governor Phillip Tower into the new Brookfield Place. So that's a development that only went to completion quite recently and is already, if it's not 100% committed, it's about 98%. Okay, so Key Quarter Tower, another one, Cause, the law firm. Look at that, they're paying, you know, close to $2,000 a square metre net. You know, so these are record numbers. So that's a 15-year commitment to the office. They're trading up, and this is what we're seeing: people trading up quality of premises. Tyro, again, the payments business coming out of Clarence Street, going into 55 Market Street. There's certainly good deals on offer, and I think that those organisations that are, you know, well informed are taking advantage of that. And that's anything from a 3 or 4 person business through to these major organisations, because they know it's a point of time in the cycle that they can get themselves set, you know, for the next 10 to 15 years. Just moving really quickly into the sales space, and this is not my area of expertise, but I thought it would probably be worthwhile just pointing this out, that there is sales activity going on. I mean, okay, so we're coming off a high base that you can see it building there, 17, 18, 19. We are seeing the return, though, of some pretty big transactions, and the offshore interest is still very much there in Australia. Probably it's maybe something to do with our dollar at the moment. Australia is a great place to invest from a commercial perspective. You know, you're buying freehold, you've got very transparent leases that are all registered, they're long-term, they've got fixed increases. It's a great investment product. So, you know, we get a lot of interest from overseas. And of course, we've got our own domestic REITs that are also quite active. And I think what's interesting, you look at a lot of those, they're doing a bit of capital recycling at the moment and trading up, and groups like Dexus are, you know, really big in that at the moment. So yields are still low and appear to be holding, at least. not sure what the interest rate cycle impact that will have though, and how that'll play out over the next few years.
Yeah. But it certainly looks like, on the face of it, if you were to overlay the interest rate chart with that, there's a reasonable correlation over the last couple of years.
Yes. Yeah, that's right.
Yeah.
So just delving into we were tracking the COVID impact very closely, particularly across our major East Coast offices, so Brisbane, Sydney and Melbourne. I thought this one was really interesting. What was different about Sydney versus Melbourne? In Sydney, we were still able to carry out physical inspections. So our market, it was still a market you could transact in. I mean, most people won't commit to a long-term lease if they can't physically inspect, understandably. And that's the situation you had in Melbourne. It was very difficult to carry out physical inspections. So Sydney was still sort of open, and we were still, as you can see, physically out there. There wasn't a lot going on, as you can see. Our numbers were quite low relative to what we would ordinarily be doing. But you can see once that lockdown lifted, and 4, 5, 6 weeks ago, people started to return to the office. Just bang, we were back on the street.
Pretty steep incline.
If we went back 2 or 3 years, where would you expect those numbers to be on the left-hand side as the sort of base level?
The base level, roughly around 100-ish is probably where we're typically tracking, depending on the year and depending on the circumstances. The circumstances in Sydney at the moment, there is very little available in the northeastern part of the CBD, which is very tightly held, and we've also got the metro redevelopment going on, and that's taking a lot of space out of the market, a lot of secondary grade space. So it's a whole lot of tenants that are pushed into the market that have to do something. And there's a couple of buildings too that have been withdrawn for development. So down at Pitt Street, Mirvac have got a big project that they're looking to get up. Those tenants have been given notice, so they have to leave. And that obviously creates activity.
Are you seeing movement towards the fringes as well?
The fringe of Sydney is really tightly held, particularly around Surrey Hills and that area. The tech industry in particular. Groups like Canva occupy a number of buildings down there. It's a really strong market. Anywhere that's got fantastic amenity and good access to public transport is doing well. It's a little bit surprisingly, North Sydney's not as performing as strongly as we had expected. I'm not sure why it is. Maybe that'll change with Metro coming through. And Parramatta has got some overhang of space. So there is a lot of supply coming through Parramatta. And the demand's been pretty anemic in that market. It's a market that's dominated by government. It's probably 45-50% occupier out there. And we've sort of expected the private sector to perhaps expand their footprint out there, but we haven't really seen that happen.
So you mentioned Canva. If you were to think, I guess, over the last couple of years, some of the major deals that you've got across the line, are you starting to see changing faces and businesses in the CBD that Australians might not ordinarily expect that they're major tenants?
Yeah, I think probably the best example of that is Amazon a decade ago was a half floor, a 500 or 600 square metre tenant in Hunter Street in the CBD. They are now a circa 60,000 square metre occupier in the city. Essentially 2 buildings, 2 Park Street and 2 Market Street. So the tech industry has really grown a lot in the Sydney CBD, and not just the CBD, but the fringe. Google's over in Pyrmont. They take up a huge amount of space over in Pyrmont. And then you've got groups like Canberra and others. There's plenty of other examples. And they're big employers. I think what's probably holding them back at the moment is they simply can't get the people. If you go on to Canva's website or Amazon's, these sorts of groups, they've literally got 100 positions open in markets like Sydney.
Yeah, right.
So I think they're probably suffering with the border being shut for so long, and I think that's probably what's holding the growth back.
Okay.
So these inspections too, you mean you don't do an inspection, you don't get a heads of agreement until you've got an inspection done. So unsurprisingly, our heads of agreements that have been issued has been climbing. And you can see there we're roughly doing about 20 to 25 in the Sydney CBD per week. So that's new transactions. So we're seeing less. At the start of the pandemic, tenants were re-signing, just holding on, re-signing for 12 months, maybe 2 years. Now we're seeing tenants have got more confidence, businesses have got more confidence, and they're looking to relocate, which is a good sign.
What's the, I guess, the ratio between heads of agreement and signed lease? Is it high 90s?
Yeah, once you get to this point, it generally won't fall over. There's generally got to be a pretty good reason. But when we do see some groups, and particularly through the pandemic, we had most heads of agreements fell over, didn't go to documentation, or unconditional, and particularly if they had offshore, approvals. Anyone going out back to the US or to Europe is just told to stick their head back in. But we've seen more autonomy coming back into the local market. So local organisations that have been running locally have been able to make those decisions. Which is good. So they're letting the reins go again. So that's really the update on the market. Happy to field any questions.
Yeah. So what is your average sort of landlord look like? Who owns all these buildings
today?
Big super funds. Some offshore you mentioned they're buying.
It's mostly the local REITs that are our clients.
So a REIT being a real estate investment trust.
So groups like Dexus, Charter Hall, AMP Capital, these sorts of groups. And if you're offshore money, you like a government investment corporation of Singapore, as an example, they mostly appoint a local manager. So that's why we're seeing these groups like Dexus and Charter Hall get bigger into that space. So we deal with them as opposed to dealing with someone who's based in Singapore or Hong Kong. And they're managing that process. There are still some privates in the Sydney CBD market, but they're fewer. There's more in markets like Melbourne and places like North Sydney. But the Sydney CBD these days is very dominated by the big institutions.
So for you watching at home, if you've got any questions, do type them into the Q&A box. We'd be happy to get them on to Cameron to answer. Another question that we sort of thought about was some of our clients are small business owners and may have to from time to time negotiate leases, and any tips for those on the other side of the table from you and your team on
so I represent landlords, just to be clear.
We should have asked this question before we signed our lease.
That's right. Look, I think that it's always a good idea to get advice, and there's a lot of tenant representatives out there that will handle that process, including our own organisation. We have a team of more or less equivalent size of landlord agents versus tenant agents, and the Australian market has become quite sophisticated in the last probably 20 years. It wasn't like that when I first started in this area. I just brokered tenants, and that's what you did, but today it's very much segmented. You're either representing the landlord or you're representing the tenant. And my advice would be, if you are contemplating this, you should pay that tenant representative as opposed to getting paid by the landlord. Get true independent advice. I think that would be my advice.
On one of your slides earlier where you had the 3 major deals that you've, I guess, closed over the last 6 months, just, I guess, for the audience, you're able to sort of walk through, you referenced some fairly high per square metre numbers, and then there was also this concept of an incentive. Could you explain the correlation between the two?
Well, the first clarification we have to make is I didn't personally broker those transactions. They're indicative of market transactions. To answer your question, Anash, so the way the market tends to operate is rents generally don't go down. I haven't really seen it in a long time. I mean, you might get some slight corrections, but we're not talking anything significant. What landlords play with is the inducement, the incentive. So at the moment, incentives vary enormously across the market. So if you to put it simply, if you're committing to a 10-year lease, you will get anywhere between effectively 2 to 3.5 years, call it rent-free. And you might get that in the form of rent-free, generally not. Generally, they want to pay your capital, all right, because they want to get that rent, the cash flow starting. And so that capital you use, for your fit out, but they're depreciating the fit out because they own it. Correct. Right. And the best way to truly analyse value is you need to look at what the face rent is and then look at the incentive or inducement that was received and come up with that effective rate. And it varies in markets. I don't know why, it's just strange. But Melbourne, as an example, every incentive is done on a net basis. In Sydney, it's all done on a gross basis. And it's a significant difference, because in Sydney, you're getting incentivised on the outgoings you're paying. And those outgoings today can be as high as $250 a square metre. Yeah. So it's significant.
And that incentive has cycles too, doesn't it? Because you mentioned if you're signing up to a 10-year lease now, it might be 2 or 3 years rent-free. But there are other times when it might be much less than that.
Absolutely. I've been in this market where it's virtually zero. It's like, you like it, great, terrific. We'll give you 3 months to do your fit out and then see you later. So you'll get a period where the lease doesn't commence in order to completely fit out, and then off you go. And it's cycles. Sydney will get back to that. There's no doubt. It's just a matter of the time.
Hopefully not at the time we're starting our next.
I hope that's right.
You timed it well this time.
You really have. I think that, and that's why we're seeing so much activity. I think in the market today, because I think most people that have a long-term lens on are going, well, now's the time to get set in this part of the cycle. That's changed.
What is it about the incentive versus rent? So why is it that rents don't typically go down?
It's all about protecting the value of the building. As I mentioned before, most of these buildings are owned by institutions. They capitalise the face rent in order to derive value, and then they'll take off an allowance for incentives. There is, leases that are coming up. So if you start dropping your rents, it impacts the profile. And so that's why there's this manipulation. You still have markets where there are, say, a majority of private owners, and for a private owner, you don't necessarily want to be writing big checks to tenants. Taking on a lot of risk quite often. So you might be inclined to do an effective deal and say, whether the value calls it 8 million or 10 million, I don't really care. I'll do the rent at 350 instead of 450 with a whole lot of inducement.
Okay. So Marsh, we've talked about obviously the size of the market. We've only really been focusing on the Sydney CBD, which is it's the biggest market in Australia. But we talk about property a lot, but typically people talk about residential investment property. When it's about why do you think it's maybe underinvested or under-discussed in terms of commercial property as an investor?
I think, one of the key learnings today is, clearly the complexity in the space. And I think the size of the transactions that we've touched on here today would be beyond the balance sheet of most of our investors. The reality is, though, that almost all of our investors would have some exposure to commercial property throughout their superannuation portfolios. And the quantum and the type will vary. So on average, if I look at our client base, we probably have about a third of our investors are in the accumulation stage, and about 2/3 would be in the retiree or drawdown stage. And as a result of that, we err on the side of using property investments in their portfolio that are listed and therefore liquid and are valued each and every day. if you were to look at some of the major institutions like the industry super funds and other major, I guess, my super type strategies, they're designed around the accumulation piece. So you've got much more larger direct holdings, commercial buildings, airports, that type of thing. So I think that's where you'll probably see a slightly different profile between the advised market and the superannuation market.
Mm-hmm. And what do you think? What are some of the differences? You know, Cameron had some great slides there on the yield. So the differences between residential property versus commercial property, you know, where they might fit in a portfolio. Do they fit in sort of different segments? Are they, you know, the growth versus income or growth versus defensive? Is there any differences there?
Yeah, it's an interesting one in the sense that, you know, some institutional players will actually define a property as both defensive and growth oriented. And, you know, I think that that's a little bit of a cheeky way to have more assets in the shares and property space than would typically be the case.
Yeah.
But when we look at it, we really, and, you know, clients would be familiar with this concept where we break it down and we talk about, well, the first starting point or foundation asset is your lifestyle piece around owning a family home. And from an investor's viewpoint, it's typically then, well, acquiring that first investment property. Now, more often than not, that would be negatively geared, which means they're, you know, borrowing 100%. It's costing them more than it's earning in those first couple of years. And as a result of that, you know, I guess there's technically only so many investment properties most investors can buy. Mm-hmm. But, you know, medium to long term, the strategy though should be paying down the family home, but then ensuring that that investment property transitions into one of those assets that we call nest egg assets. So a nest egg asset is really something that has no debt or an obligation, and you're earning an income from that property that you don't need to work for. And that could be your superannuation, it could be a share portfolio without a debt, or it could be an investment property that you've slowly paid off.
Mm-hmm. So a commercial property could potentially
absolutely
meet that, and you know, often the yield that you're getting on a commercial property is typically a little bit higher.
But it has been historically. But, you know, if you look at some of the transactions that we're seeing at the moment, you know, you're seeing properties transact on a yield of either side of 2% for some of these blue chip businesses. And the challenge for an individual investor is that, you know, even with rates where they are on a commercial asset, A, you've got to have a much larger deposit to fund that. And B, you know, the cost of the financing isn't going to be like resi finance. It's going to cost you more, which means it's more negatively geared. So it's certainly not beyond the reach of all investors, but it is certainly harder to get there.
Yeah. And so does that mean it's moving more at the moment into the growth buckets? Are you buying that property with expectations or aiming for more growth than maybe at different times in the market cycle where you might be buying because you've got that higher yield sort of expectation?
Well, it's a challenge. I think that there's, in some areas, there's a flight or a rush for income. And there aren't many places at the moment where you can get that reliable, steady stream of income. So you're not getting it from cash, you're not getting it from bonds. And, you know, I think the expectation is over the next 12 to 24 months, interest rates aren't going to move materially. So, you know, there's money coming in from offshore and domestically. People are buying these blue chip property pieces that with, you know, tenants of the likes of Dan Murphy's and Woolworths and so on, with 10, 20-year leases, thinking that that's a certainty. The challenge is, though, what's going to happen to the potential value of that property when rates start to move. You don't really want to be on the wrong side of that.
Yeah, but at the moment they're kind of taking the view that we'll take the 2% because we can only get
correct
0.2% on our cash.
Correct.
So yeah,
correct. So some of those larger transactions are getting down to those numbers because those with big checkbooks can do it. But you're still seeing transactions in more suburban areas where, you know, might still be either side of 4% if you're lucky.
So what other sorts of, we talked a lot about the office space, which is, yeah, your bread and butter. What other sorts of commercial property assets are there? You touched on, you know, the Woolworths and the Dan Murphy. So,
well, I mean, a booming segment at the moment would be the industrial space. And that's kind of really sort of kicked off at the start of the pandemic when major institutions realised that, you know, supply chains could be impacted by freight and logistics and whatnot. So they started to therefore house, I guess, more toilet paper in warehouses that they could reach.
Yeah.
So the industrial space has grown quite considerably. I'm sure you've seen some of that.
Oh, absolutely. That, you know, the industrial market for us has just been an absolute booming market. You know, driven by all the things you're talking about. And, you know, we think that the pandemic just accelerated a lot of, you know, trends that were to occur, you know, brought those forward. And it's meant that, you know, that's had an impact on, you know, the types of properties that these organisations that are serving the market require. And they've become a lot more sophisticated. You know, 20, 30 years ago, it was a shed. Now it's, you know, a automated space with a lot of technology.
Yeah.
So it's quite different.
And what sort of areas are really going ahead in that space, geographical areas?
Well, I think anything that's got a proximity to a major city and great access to you know, arterial roads and those sorts of things. I think that and ports, that sort of those sorts of things. That's the space that's probably been the most sought after.
Yeah. And Marsh, do you think, you kind of had, I guess, a warning around the potential for interest rates to increase and what that might mean for property values for people who have, you know, taken the steps? They've got a couple of investment properties, maybe paid down their home, and thinking about commercial property as a potential asset. What are some of the things to be mindful, some of the things to look out for?
Yeah. Well, the reason I raise that is because, you know, with rates where they are, and rental income being consistent, and there's possibly not a significant gap between the income that you're receiving and the cost that you're incurring. And as rates start to move, that may change. And if you've got a big lumpy asset and your cash flow isn't able to grow along with that, you know, it could be a gap. So, you know, the simple things are making sure that you've got provisions in place, making sure that you are consistently paying down some of those debts. And, you know, if there's any accountants listening, they might get a little bit frustrated around our pension for encouraging our clients to even slowly pay down some of their investment debts, because you get a multiplier there, and that you'll get a reduced rate, because if you have interest only debt, typically the banks will charge you a little bit more. But it also provides, you know, that sleep easy or peace of mind knowing that each and every year your debts are slowly going down. And that in time will allow you to potentially acquire additional assets if you want to.
Yeah, makes sense. For our clients at the moment, you mentioned that they do probably have access to commercial property in some way, shape, or form. How is that typically? We talked about the REITs, so the real estate investment trusts. So how does that typically fit into our portfolios, and what might clients look out for when they're looking at their statements? Or
so there'd be, I guess, two parts to that. So those that have an investment directly, so those that we work with that would be involved in that space might be a medical practitioner that might have bought their commercial suite, for example, in their self-managed super fund. So that's pretty obvious and it's in front of them. They know that they own that office space. But if our investors were to look at their portfolio statement, you would see often it would be in the Australian shares listing, there might be an exposure at the moment to Goodman's or some of the other developers. And that's really because the investment managers we've selected have thought, well, actually Goodman's at this point in the cycle represent good value, so we're going to invest in that business. Outside of that, we would have a relatively low cost exposure to an exchange traded fund that's promoted and managed by Vanguard. And within that, there will be all of the major office assets. And so typically we haven't tried to cherry pick a specific investment manager. We let the fund managers do that, and we get broad exposure to the property market via Vanguard.
And so Vanguard then goes out and invests in those REITs that Cameron's
Correct. So all the REITs are the listed property trusts. And, you know, part of that is, you know, there was a learning for us throughout the GFC, and, you know, there were a range of investment managers that offered a property type solution for investors. And if you can think about it logically, you know, you're effectively investing in an asset, wanting liquidity, but broadly speaking, property is not a liquid asset. you know, if you're wanting to access something, you can't easily sell off one of the floors. And one of the challenges throughout the GFC was that a number of these property assets were overly leveraged and our clients were not able to access the monies from those. So now we've learned from that experience, and we are on the side of using listed strategies, which are effectively liquid. So our investors not going to get locked out of redeeming those if we need to.
Yeah. And I think to your point before, Cameron, that's more common now. There's less, you know, private owners or you know, trusts set up to own one or two assets, which is where you do get into trouble if, you know, your big tenant leaves you one asset and you've got some leverage on it. How do you keep paying out your investors? Well, you can't. But if you've got a diversified portfolio inside a trust and they own a number of buildings in the area, and then you've got more flexibility, and then you list it and you've got regular liquidity. So
that's right. Yeah, that's how you solve the liquidity piece.
Yeah.
Yeah. And these groups are hugely diversified typically. So yeah, to your point, if you do lose Telstra out of a building, that's okay because they only make up 2% of your total income. But if you go into a single asset fund, that can be get caught out.
Yeah. So our landlord here is Mirvac. So you know, people probably know Mirvac more from a residential viewpoint previously, but they're probably equally as big in the commercial space now.
Yeah, Mirvac are one of the leading office owners in the country. Yeah. And developers.
Yeah.
They just developed for Suncorp up there in Brisbane. They do a high quality product, and they're doing some of the metro stuff here in Sydney. And they've got a big site down here in Pittsburgh. So they're quite active in the office.
And really broadly diversified, long track record of doing a good job, and you know, somebody you'd be comfortable looking at as a potential investment.
Yeah, I mean, touching on that prospect as to whether it's appropriate for investors to participate in that commercial space, and almost all of our investors are to a degree. But you know, there's an analogy and a story I've often heard. It's around the concept of monopoly, and you know, we encourage our clients to buy their first home and to live within their means and pay down those debts, and then to start to acquire an investment property outside of that. And you know, if you think about, I guess, the risk curve, what is the least risky strategy and what is the most risky strategy? Buying an investment property that's residential would be less risky. And if you think about playing the game of Monopoly, you know, before you can buy a hotel, you've got to buy 4 houses. So, you know, we would definitely encourage that investors think about that as a process, so that you bought your first home, and then before you think about maybe that big stretch of the commercial property, getting 2 or 3 investment properties that are residential in nature under your belt, and make sure that you've got equity in those before you can buy the hotel or buy the big red asset.
Yeah, makes sense. Sounds good. Well, if there's any other comments on closing, we've got a couple of minutes to go, but any other comments, anything else you think, tips and traps people should be aware of in the current market? We've talked a bit about that, but anything else you gents would like to add before we wrap up?
No, I think so.
Oh, pretty good.
Yeah, covered it all off. Finish on the monopoly note.
I had to get that in there.
Well, thank you at home for listening. Hopefully you found that interesting. If you do have more questions, please do send them through to Marshall or I. We can get through to Cameron, or we'll come back to you on those. You will receive in our newsletter a copy of the recording and the slides that Cameron shared today as well. So please enjoy those in your own time. There's some good information there as well. But thank you for your interest and participation throughout the year. This is our last webinar. We'll be back next year with some more webinars. If you've got ideas about what you'd like to hear about as well, we'd love to hear from you on that as well. And Cameron, thank you very much for your time today.
Thanks, Jeff. Thanks, Marsh.
Thank you.
Nice to see you.
Thanks very much. Bye.